What's going on, guys? Welcome to The Journey, where we deep dive all things real estate and investing. We pick the brains of market leaders in their field so that we can fast forward you from where you are to where you want to be, utilizing their knowledge and experience. My name is Austin Mitchell, and on today's episode, I have joining me Deanna Ashton. Deanna's amazing. She's a loan officer with American Financial Network, and she's based here in Chesapeake. She's helped countless clients through the entire loan process, and so we're going to kind of get the inside scoop of how she matches our objectives with the best program. And so we're going to learn about the different loan programs, how to qualify for these loans, and then ultimately what does that loan process look like to kind of help fast forward us through this entire thing. So if you wouldn't mind, Deanna, please just give us a little quick background on how did you get started and how did you ultimately become a loan officer?
So during the pandemic, I had a family member who was working for American Financial Network. My sister was working there as a loan officer, and she had come up to me and said, you can work there as a loan officer assistant, not having your license yet, and assist loan officers might be a great fit for you, because I was kind of looking to get back into the job field because I had been home with my kids for a few years. So I have a lot of experience with sales, with marketing. I had worked in banking before, but not necessarily with loans. So a lot of that was brand new. So starting as an assistant was great for me. I worked with 2 different loan officers, got a lot of information from them, learned a lot from them, and decided to go ahead and get my license. So as soon as I was able to, took the class, took the test, was able to pass it the first time, and here we are.
Awesome. So you kind of got to test the water before you jumped in fully.
Yes.
Okay. Well, that's good. So that makes the transition a little easier, and I'm sure once you got that, it was kind of off to the races at that point.
Yes.
Perfect. So I know this is a good question. So what does a loan officer do? And anyone getting into investing or trying to find a primary residence, like why would they seek a loan officer out?
Okay, so if you're going to buy a house, whether it's an investment property or your primary home, you're going to need funding. So you're going to need a loan officer, whether it's me, whether it's somebody else, to help you with the funding of that loan. Really what we do is we first off look at your documentation to issue that pre-approval to let you know what you could even be pre-approved for. And then once you get that contract on that house, we help you through the entire process. With the loan officer in our office, we're going to be helping with ordering the appraisal, we're going to be helping with title work, and we're going to be making sure that everything is done to get you closed.
Perfect. So essentially anything to do with the funding of the the transaction, y'all are going to manage. So
Yes,
if you don't have 100% cash coming to closing, you'll need a loan officer to help secure funding. Perfect. And then they're going to orchestrate all of that stuff for you, hold your hand through that process. And so if somebody is trying to look for a primary residence, so their first time home buyer, second time home buyer, what kind of programs are available for them?
Okay. So there are a lot of programs available, and it really depends on a few things. Number one, if you're active duty, the VA loan program is almost always going to be your best bet. If you have that VA entitlement, the rates are really competitive. There's a little bit more flexibility with credit score and your debt to income ratio that they require. And it really tends to be a better program almost always for active duty and also for vets as well. If you're not able to do the VA loan, you're not active duty, then there are also FHA loans where you only have to put 3.5 or 5% down. And sometimes you can get down payment assistance with those as well. And there are also in Virginia housing loans. These are great for first-time home buyers. Your debt to income can be at 50%. They offer down payment assistance programs, or sometimes you can get full financing, which means you don't have to put anything down. And they also have grants available. All of those are based on income. So this is why it's so important to work with a loan officer. We sometimes call ourselves mortgage specialists, because really we're going to look at the entire picture. We're going to talk to you. We're going to evaluate your credit. We're going to look at your income. And we're also going to ask you questions like, do you have money set aside for closing? What type of monthly payment would you feel comfortable with? It's not always about what you can get pre-approved for. Sometimes it's also about what's realistic and what it would look like for that client. So everything is very much based on that, more than just looking at a list of programs.
Absolutely. Yeah, and I think it's so something that I learned, and you can confirm this because now you're the expert in this, but I've always seen, and especially when I got into this, I always heard about the loan programs, about this much down, with the VA at 0%, or with the FHA maybe 3.5%, right? 3.5%. But then there's closing costs.
Right.
And that's about 3 to 3.5% in general.
Right.
Yes. So this is something that for some reason is just, it never comes up clearly, but I will be the one to clear this up for y'all. Anything that is your loan program, that down payment that they tell you, that percentage that you always hear is going to be strictly to secure your funding.
Yes.
But you also need to add in another 3 to 3.5% of that purchase price to come to close, okay, in order to close on that property, because there are fees associated with the transfer and inspections and things to get that property signed over into your name. And so this is where the loan officer can also help you to know exactly, like to the dollar, how much y'all are going to need to come to closing on that day. It's not just what it takes to secure the loan. It's two separate.
Right,
Yes.
exactly. And a lot of people also don't realize, like you said, you're going to want an inspection. Never skip the inspection, whether you're a first-time home buyer or not. So that's going to be a cost. And you're also going to be paying for the appraisal on the home. And a lot of things that people don't know is that if the appraiser finds something wrong and they have to send the appraiser back out, as the buyer, you actually have to pay for that appraiser to go back out, which can be $200, $300. So like you said, it's so important to sit down with a loan officer. We can show you an estimated fee sheet. We can give you an idea of what those things normally cost. And that way you can go into it prepared, because, for us, of course, our responsibility is to the client, and then of course the responsibility to the bank, because we want to make sure that you are going to be able to stay in that home as long as you want to. We don't want to put anybody in a position where they move into the house and then they can't afford it. I mean, that's the whole reason why we have rules, guidelines, and we have underwriters who help review those files with us.
Exactly. And so if somebody is coming in to get a loan, like what are the things that you assess in order to qualify them?
So first, we're going to have to look at credit, because with most of the programs, credit is a set guideline. For example, for the Virginia Housing Program, they have all those great benefits depending on your income, but your credit needs to be at a 640. They're also going to be looking at your documentation for your income. So we need to be able to see not just how much you make, but how you're paid. For example, if you've been working for a year and you've been working as a W-2 employee, and then just a few months ago you decided to be maybe a realtor, right, where you're working 1099 or self-employed, you have to be in that self-employed or contractor status for a year before you can apply for a loan in most circumstances. Because like I said, we want to make sure that, or at least the bank is making sure, that you are going to be able to repay that loan. So they have to see some security in that income that you're having. We're also going to be looking at your bank statements, and a lot of people will say, well, why do I need my bank statements if I'm able to get my closing costs covered and I don't have a down payment? Well, like we had just said, with the inspections, appraisals, things like that, you're still going to have to pay something. And we also are looking to make sure that there aren't unverified cash deposits. So a lot of people I know will have a side hustle, things like that, and people will cash out them large amounts of money. Don't do that, because we have to be able to see where that comes from, and that really can be a game changer. And it's unfortunate when something like that, prevents people. So we always tell people we need those last 2 months of your bank statements. Make sure that looks clean. If you need to open another bank statement to deal with your own personal stuff in the meantime, then do it. We'll look at assets as well. So some people will pull money out of a retirement fund or a mutual fund or things like that for their closing, or if they're putting money towards the house, we'll look at that as well. And of course, we look at your ID, and we'll look at your tax documents, your tax returns, and your W-2s. And that's just to compare that against the income and to see, like I said, the status of how you're getting paid.
Absolutely. And so those are the tactics, but I've always kind of, from my experience, I find the biggest run-ins are going to be the credit and then the DTI, so the debt to income.
Yes.
And so what are kind of the ballpark ranges? I know for each loan program it's a little different, but it's generally like 50%, 45%.
Yeah. So if you're looking at VA, it's a little bit more flexible. If you're looking at Virginia Housing, if you're in Virginia, and even if you're not in Virginia, I know Tennessee has a program that mirrors ours, and there are other states that have it. But if your state has a first-time homebuyers program, most of the time it's 45 to 50. Here in Virginia, they just upped it to 50%, which is great. If you're looking at FHA, you really want your credit score to be closer to 600. We can do approvals under 580, but you have to understand that if your credit score is 580, but then the income is is a little bit lower, then it's hard to work with it. I always tell people try to aim for 620 to 640 if you can. And of course, don't stop there. If your credit score can go up further, then do that, because that's going to also give you a better interest rate on your loan. And something that I like to do is network with all sorts of people in the industry. So I have a lot of professionals that I work with that are credit repair specialists, because we can help and give advice. But if it comes to, having to get something off of your credit report, I can't do that. But I can find somebody who can help.
And I think that's major. So one of the big things I was going to touch on was the fact that going with the loan officer, they generally have the connections with the credit repair.
Yeah.
And a lot of people don't think about their credit until they need their credit. And so it's one of those things that usually isn't out of the blue, but it becomes a problem when it becomes a problem. And they have the assets to come in and try to help increase the scores to help better qualify you. But that's the whole reason, again, to get a loan officer, because it helps orchestrate. This is one of the steps in that process.
Yes.
Get the credit right, get the debt to income correct, and then it really opens the door for what you can qualify, especially getting into the house that you want.
And also make sure that if you're logging on your Credit Karma or whatever on your phone, that you are aware that when we actually evaluate your credit, when we pull your credit, it's not the same thing. We're looking at a FICO score, and the way that they calculate that is differently. Some tips that you can do for credit, in addition to making sure, of course, you're making your payments on time, is to keep your utilization low. So you want to make sure that you're keeping your utilization at 30% or below. So if you have a credit card and you can go up to $1,000 on it, you want to keep the balance at $300 or less. So those are just some kind of tips. If you're like, maybe I don't want to buy now, but I want to get prepared, go ahead and start doing things like that. And you can also call us and we can evaluate their credit now, even if you're not thinking about moving right away. I mean, I have clients that, because they're moving in the summer, both of them military, they've already started the pre-approval process because they want to make sure debt to income is good, credit is good. It's not going to really negatively affect your credit score to do it now and then have to reevaluate a few months later closer to you closing. So I know a lot of people are hesitant about that, especially if they're not sure what their credit is, but I always tell people you don't know what you don't know. So what if you're ready to buy and, like you said, they pull up that credit and there are late payments or something that we need to get off there, and we just don't have the time to do it in the frame that, your lease is up or you need to relocate or whatever it might be.
Yeah, it's like a pre-approval.
Right.
Perfect. Yeah. So get the homework done before you need to get the homework done. And so can you expand? So I think 640 was that would be a sweet spot to get started. So before you if you want to start this journey now, 640 can be the target for that, and then 45% DTI. And so what does that look like? What is DTI, and how do y'all calculate that?
Sure. So we're going to look at all of your current debts. This does not mean the total amount on your credit card, on your student loans. It just means your monthly payment. So let's say you have a credit card that has a large balance, but your revolving monthly payment's only $100. That's just what counts against you. Student loans, I could make a whole 30-minute video about this, but student loans, because a lot of people have them in deferment, the rules on this are changing, and they have recently changed. It used to be that we had to count 1% of the total amount of debt you have left. So if you had, $200,000, and we'd have to count $2,000 of that as a monthly debt. Now it's down to 0.5%. So even if your loans are in deferment, we have to count that against you, so to speak. There's another option, and I actually just made a video on this yesterday and got a lot of people calling me saying, I didn't even know that was a thing. You can also call your creditor, whoever holds your student loans, ask them to get you on an income-based repayment plan, and they can usually give you a very low monthly payment. I had a borrower that the monthly payment that we were going to have to count against him was $1,000. He got it down to $200.
Nice.
So, and he just has to start making those payments, and usually within a month or two that shows up on your credit report. So that's another debt that would go against you. And then of course, whatever the cost of the house is. So we're going to be looking at that total monthly payment, which is going to be the cost of the mortgage, and including the principal and interest and taxes. And we're also going to be looking at, if you're looking at a condo, your HOA fees, which is why if you're thinking about looking at condos, you definitely want to tell your lender up front, because as they're doing the calculations to see what you're going to be pre-approved for, they need to be considering that $200, $300, $400 association fee that you're going to have attached to that house.
Mm-hmm.
So we look at that against what your qualifying income is. And hear it again, qualifying income. So if you have a side hustle you haven't been doing for 2 years, or you babysit on the side, you get cash, we can't count that unless you have that documented and it's actually been on your taxes. Another few things that could count as income, if you receive any sort of disability benefits, Social Security income, if you receive anything for your children, all that's also included in income, as well as child support.
Okay, excellent. And so I think a big thing to really drill in there is going to be your total monthly payment isn't just going to be your principal payment.
Right.
And so it's going to be your interest, your insurance, your taxes, and obviously any HOA or condo fees. Mm-hmm. And if y'all want to know how to calculate those, it's usually pretty simple. Most of them are listed on wherever you're looking at, whether Zillow, but if you're working with a realtor, on the MLS, it'll have the exact taxes, and you'll just divide that by 12. That'll go into your monthly payment. Your insurance, what do you ballpark generally for insurance when you're making loan assumptions?
So actually what we do with our insurance is we usually look and request a quote for that area and give them kind of like, if someone already has a house that they're looking at, then we'll tell them, go get a quote from a few different insurance agents. But normally we bank on that being about $100 or so a month. But it depends, of course, on the type of house, how large the house is, and also down here you have to keep in mind sometimes you need flood insurance or additional insurance. So that's another reason why early on in the process we make sure that people get that right away, because we have to make sure that you're able to afford that with all the other things that go into that monthly payment.
Absolutely. And so those are generally the ones that are missed or not really accounted for because they're not as obvious, but they do add a couple $100 a month to the payment, which obviously then decreases or increases your debt to income. And so I think all those are very beneficial to understand. And then how about the difference between a direct lender and a big bank? So what are the differences there, and what are the benefits to go with the direct lender versus a big bank?
So I always recommend that people go with a direct lender, and there are a few reasons. Number one, if you're working with a direct lender, 9 times out of 10, when you talk with them, you're only going to be speaking with them. They might have an assistant you speak with as well. And then once the loan goes into the processing part, you may be speaking with the processor as well. But it really allows you to get your questions answered more quickly, get information more easily, and get the information to you more clearly. It also, in my opinion, I think it just kind of streamlines the entire process, because you're not going back and forth between sending documents to one person and then there's somebody in a different state, in a different department that you have to resend everything to. It just makes everything a little bit easier to deal with. And they're also usually a little bit better about communicating with your realtor, with the title company, and they have their own process of doing things and getting things done. So if we were working on a loan together, then I'd say, hey, Austin, I got the contract, I sent out the disclosures, I'm waiting on these signatures. If he's having trouble reaching the client and I've talked to them, then he'll be able to, talk to me, and I'll say, yes, we're good to go. They've already paid for the appraisal. You should be getting a call for that soon.
Absolutely. And for me, point of contact is everything. So you have a very personal contact with someone that you can reach out to with any questions that come up, instead of having to jump through hoops, send in emails to try to get to the right person. And generally they work hand in hand with your realtor. And so this becomes the team. The loan officer is the financial portion. The realtor is all of the things that have to do with the actual real estate transaction. And so all that, and when they communicate, we can really streamline and speed through anything that does come up. Any hurdles that come up, they're taken down a lot quicker when you have that direct contact, instead of going to a big bank and trying to hunt down whoever you're looking for. So it is very beneficial on that front. And then if somebody was looking to or considering taking a loan to invest in real estate or get their primary residence, what would be the first step that you would recommend? that pre-approval?
So yeah, well, you still have to get pre-approved, like you said. As if you're not putting 100% of your money down on the house, then yes, you still have to be pre-approved. And there are different requirements for the investor programs as well. One program that is really popular and a lot of people really are excited about now for investing is our DSCR programs, and we can do all of the regular programs in-house, and we can also do these other, what we call the non-QM programs in-house as well. So with this program, if you were to buy a house, and let's say the mortgage on it would be $1,500, but there's either a tenant already in place or tenants already in place, or you can see on Zillow the estimated rent exceeds what the mortgage would be, then we don't necessarily need the same documentation. We're not going to need the income documentation. Of course, we're going to have to verify funds and stuff for closing, but we're not going to need the same things that we need for, a first-time home buyer looking to buy a house with a Virginia housing loan, things like that.
Right. Well, to touch on that, so what is a DSCR loan?
So it's basically just for investors to use to purchase the home, and they don't have to worry about doing the other documentation, like I said. And they're basically buying the home with the sole purpose of using it as an investment. So they're not going to be moving in part of it. They're not going to be using it for their personal purposes at all. So they're just having to show that basically the house can pay for itself.
Yeah,
a simple way to say it.
Yeah.
There are other ways to invest, though, with primary home loan programs. You can do a VA loan program if you want to get started in investing. If you get like a duplex and you can live in one side and rent out the other and still get the benefits of the VA loan with usually a lower rate and things like that. You can also do an FHA loan for a multifamily unit and do the same thing. So for people who maybe are not seasoned investors that want to get started in it, those are great ways to get started and still get the benefits of those first time or, primary home buying programs.
Absolutely. Yeah, I've got a client of mine who's closing on Monday actually he's a military veteran and he's using the VA to buy a property. We actually went with the per room model for him because we were searching duplexes. The multifamilies around here are a little expensive right now. And so we found better cash flow by getting a 3-bed, 2-bath townhome because the prices are generally a little cheaper.
Yeah.
And then he's renting it out per room, but he's using that program to get into that space, with minimal money down. And then obviously having a good realtor, we can negotiate the terms better on your end. So we're able to cover his closing costs. We got him a new roof. And that's where a good realtor comes in. And so if you really want to be an all-star coming into this game, get your pre-approval with the lender, because then when you come to the realtor, we can really get it started. Because if you don't have a pre-approval, no offers can go in because they're kind of taken with a grain of salt if we don't know if you can qualify. So yes, we can show you homes. Yes, we can go see and kind of start the process. But really, there's no ground to be had until you have a pre-approval letter.
Right, exactly.
They go together with your first offer. And so when we submit an offer, unless it's accompanied with a pre-approval, it's not taken very seriously.
Right.
Because that other realtor is not going to take it seriously. And so this is really how, if you want to start your real estate journey, get your pre-approval by getting your DTI in check, 45% or low. Get your credit score using the tips and tactics Deanna just had. And if you need to work on that with somebody else, then reach out to Deanna. She'll put you in contact with the credit repair, and all that can be started now. And then that's the time, once you get those set, you'll qualify for the maximum amount. And then you get your realtor to where now we'll go show you houses and we'll find the perfect one, because you'll actually have all the ammo needed to buy that first property.
Right.
So that's very important. And then if somebody did want to get in contact, or did you have any other tips and tricks or myths that you've encountered?
Oh, there are a lot of myths. A lot of times people will call, they'll think, you have to put 20% down, which you almost never have to put 20% down on a loan. A lot of people right now, this is the big thing, and I'm sure you hear it, it's a terrible time to buy. It's a terrible time to buy. Well, the rates are actually going down. The house prices are going down. And actually, if you want to buy before the spring or summer, get your pre-approval and start looking now, because guess what? In a few months, everyone's going to be looking, because then they're going to be realizing the rates are what they are, whether they're up or down, and people are going to need a place to live, especially here where we're in a heavily military population. The summer is the busy season everywhere, but especially here, because people, even if they move with the military, they might have their families stay behind, and then everyone's moving around in the summer. So that's a big one about it not being a good time to buy. And I think a lot of people in general just think that they're going to be putting so much money down. So, working with a realtor is great because, like you said, a lot of people now are able to get those closing costs and some of those things covered and closing really with little to no money down. But you're not going to know until you get the pre-approval and, hook up with a realtor and start looking around.
Absolutely, yeah. So we kind of dive in the same way Deanna does with your finances, we do on the actual transaction. So we'll negotiate anything to do with that specific house. Like if it needs a roof, we are in a place where we can negotiate those things, and that's where we become a benefit because we orchestrate the entire process from start to finish. But I think I also want to second, this is a good time to buy. The reason being is because everyone is hearing that. When the masses hear this isn't a good time to buy, then guess what? All the sellers are now having less people approach them to buy their property. But the seller doesn't care what the world is doing. They need to move out of that property for their own personal reasons. And if you can be the one to come to them and make that possible, you're in a much better position to negotiate. When that seller has 10 people who are knocking down the doors to buy this property, you have a lot less leverage because they don't need you.
Right.
But when the seller needs you as the buyer, you have a lot more leverage, and vice versa. When the things are going crazy and you are a seller in a good market where the interest rates are lower, it's a lot easier to qualify. You have a lot more leverage when you have 10 buyers on your door, and so that's the better time to sell. And so right now is actually a much better time to buy because there are fewer buyers out there, and so the sellers are getting a lot more. They're a lot more motivated because they have less options. So this is actually the perfect time. As soon as you see everyone else going to buy, if you're trying to buy, you lose a lot of your power. And so anyway, I think that's a good point to say. But how about if anybody wanted to contact you about starting this loan process, how do they get in touch with you, Deanna?
You can always give me a call. My number is, I don't know if you'll have it on the bottom or if I should just say it out.
Yeah, say it out and I'll put it in the description.
It's 703-965-6740. You can also email me at dashton@afncorp.com. I'm also on social media. Deanna Ashton is my Facebook handle. I love educating people, which is one reason I was excited about doing this interview with Austin. So I do a lot of videos on all sorts of tips for credit, tips for mortgages, different information on programs. Working in the mortgage industry, it's very fluid. Things are always changing. Guidelines are always changing. And so we really are always getting new information. And I always want to be that first person to pass it on to my realtors or clients.
Absolutely. Perfect. Well, I appreciate that. So yeah, we will put that in the description. If you want to get in contact with me, it's bettertogether.realty. We have a couple cool tools. If you are a seller, then we actually offer a free personalized home valuation, which will, the same way we value all of our properties, we'll look at the comps around your house and actually give you a real. This isn't like a Zillow estimation. And if you're a buyer, we do have a find your perfect neighborhood tool to where we can narrow down everything that you're looking for as far as what's important to you. And then we'll actually place you exactly where the best neighborhood would be for what you're seeking. So very useful tools at bettertogether.realty.com or bettertogether.realty. And so anyway, I do just want to thank you again, Deanna, for being here and sharing all this.
Thanks for having me.
Super exciting. Yeah. And I look forward to having you back.
All right. Sounds good.
Thank you.